been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is President of Heartland Investment Group, Darin Garman. Now, Darin is a published author, former bank owner, and currently owns and manages a $50+ million portfolio. He is widely recognized as one of America's top go-to guys for all things multifamily investing. His experience spans more than 30 years and is hyper-focused on investments in the Heartland region of America. And so with that, guys, I'm excited to welcome back Darin Garman to the show. Darin, how you doing, buddy?
Hey, I'm doing great. It's good to hear your voice, Kevin. Good to be talking to you today, buddy.
Yeah, no, excited to have you back here. I look back, it was about 5 years since we last talked. And as we know, a lot can happen in 5 year span of time. And we were chatting a little bit before we started recording. And it sounds like the last 5 years for you has been incredible as it has for us. And so very, very grateful and blessed, number one, that we're in a new year here. You know, as we record this, we have already entered into 2021. And so I'm excited for the things that we've got coming. I'm excited to chat with you about, all the exciting things that you guys, have coming your way at Heartland Investment Group. But, Darin, for those that aren't familiar with you, that might not have listened to our past show together or haven't heard you on other podcasts, what have you, maybe take a few moments and just tell us a little bit more about yourself, give us a little bit of a background and, how you found yourself into real estate.
Yeah, sure. So I'm the guy that is known as the former Iowa prison guard, and there's not a lot of folks, Kevin, you probably talked to that said, yeah, before I got into the real estate business, I worked in a prison. So probably a little unique there, and without boring the audience with just a long bio. So I graduated from college thinking I was going to be in the criminal justice field. Found myself working for the Department of Corrections as a prison guard in the late 80s. Did that up through the early 90s with, at that time, the thought of really getting into the real estate business. I didn't really know much about it. From a schooling standpoint, no training in real estate finance, nothing like that. But it looked to be something I would really, really enjoy. So I quit my job at the prison, jumped into the real estate business. So this would have been in the early 90s. And what I mean by jumped into is my start was being a real estate agent / real estate broker. Okay. So I was focused on understanding the business from the selling side of things. So what I started to do is focus on selling apartment communities in the early 90s. And this was think of it as like the eastern half of Iowa is where I did this. And I decided that not because I had any kind of big idea or any kind of foresight. I mainly started it because I thought it might be an area where there's a little less competition, Jumped into the business early 90s as a real estate agent selling apartment communities. The first couple of years, pretty much hand to mouth in terms of really making any kind of a traction in terms of any business. But after a couple of years, started to get some traction made. And then over a period of 15 years, I went from a guy that didn't really know what the hell he was doing to selling, over 80% of multifamily transactions, at least in the eastern half of Iowa, 4 units on up, pretty much went through my office. And the interesting thing is, you notice the first 15 years, I didn't say anything about owning anything. You probably noticed that. So for 15 years, I sold a hell of a lot of apartment communities. Didn't own any of them. So it took me, 15 years to figure out, maybe I want to start owning some of this too, rather than selling it. So I slowly started to purchase small apartment communities, work my way up in terms of owning some apartments and getting experience, not only as an owner, but I'm one of these guys, Kevin, I started out doing everything myself too. So I was the leasing guy, the maintenance repair guy. I mean, I did everything, and slowly expanded the holdings until I got to a point where I started getting investors contacting me, basically saying, "Hey, Darin, you know what? I like what you're doing. I see that you've got ownership in these. I'd like to own some of these with you." And that would have been, let's just say, like 14, 15 years ago. And so I started to focus my business really on not only owning the real estate, but working with folks that would have an interest in owning the real estate too. So as a result of that, put together a number of partnerships over the years to own properties, anything from a smaller 12 unit all the way up to, something over 100 to 200 units. And so you fast forward to today, and I pretty much spend my time working on the management, the asset management of our portfolio. And it's in Eastern Iowa. It's Iowa area market. Have quite a few partners that are involved with us too in owning the properties here. We still are active in the brokerage side of things. We still sell a number of apartment communities. We still do that. But most of my time is spent on the ownership side and dealing with our investors and our properties.
Got it. I appreciate that background. I'm going to back up a little bit. There was a point you made, maybe not a point, but just kind of going through the evolution of prison guard to agent broker to buying your first property. You had mentioned beginning, when you bought those first couple of properties for a period of time. I mean, you did everything. You were the leasing agent. You were the maintenance guy. You basically handled A to Z, the entirety of that role of property manager, asset manager, all the above. And the question I have is, what do you find that there was a lot of benefit?
The question you probably have is, how are you? So you got to be crazy.
Yeah, right. No. I think there's a lot of benefits to. I want to ask you. I think there is, but were there benefits that you felt carried over to your business today from you having to be in the weeds and learning every aspect of the business? Not saying that you ever wanted to be a plumber, you never wanted to be an electrician, you didn't want to be a leasing agent, but you got a little feel for each and every one of those roles to a certain extent. And I personally feel like that from my experience, I did the same thing when I got started, and that's really helped me over the the years now, the 2 decades. It's really helped me manage projects, right? Understanding every aspect of it really helps you manage and find the best vendors for the job and be able to interview and selectively choose or kick away the bad actors, right? And only work with really good folks. But unless you know what the hell you're doing, it's very hard to do that. Do you agree?
Yeah, and you bring up, you hit a really, really good point. In truth, I'm really thankful I did, because now I know what I know. And, I've got a number of investors that contact me, and I'm sure you do too, for advice. And one of the things I tell guys when they're looking to get into, their first apartment community, whatever investment, it could be any investment property, is I really encourage them to do a lot of the management themselves, at least maybe for the first year or two. Because after you do that, to your point, the experience is invaluable in knowing what you need to know to be a really good manager, owner, investor moving forward. So invaluable. I'm able to make the kinds of decisions and the kind of judgments, not only quicker, but much, much more effectively as a result of doing it myself. So no, you make a really, really good point.
Is it only multifamily, Darin, or are you diversified into other commercial asset classes, retail, self-storage, office, any of the above?
Self-storage, office buildings, and we've also had some industrial buildings too. So one of the largest industrial buildings that we've had, we don't own it anymore. We had a building that was a little bit over 100,000 square feet that we sold a couple of years ago. So I've kind of had my hands in, interestingly enough, I've not had my hands in any mobile home investments. And I don't really know why. And not because I wouldn't want to. office buildings and some retail, all on the smaller scale. We've had a couple strip centers, a couple smaller office buildings over the years. We had a larger industrial property. So, so had some involvement in those, but pretty much 97% of what we own is multifamily.
Got it. And I'm backing up a little bit. I know you said you've owned office and this and the other industrial. You don't own any of those any longer, or are you still involved in some office and or retail?
Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche, and that's the phenomenal niche of mobile home park investing. Now, for those that don't know, I've been a full-time real estate investor for more than 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in Growth and Income Fund 3. When you invest in our fund, you get immediate diversification into multiple deals we acquired off-market that are already performing and have built-in sweat equity. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please visit us at investwithsunrise.com and request access to the investor presentation. It's absolutely free, and you'll get instant access to review the off-market deals that we've already purchased that you can co-own with our team. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-227-4359, and our investor relations team will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule the call, and let's jump on the phone. And with that, guys, I'd like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show.
Oh, yeah, I'm sorry. So we don't own any retail anymore, and we don't own any industrial anymore, but we still own office, and we still own self-storage. And just really quickly, we're not in the retail or industrial asset class because of anything that recently happened economic-wise or COVID-wise. It was just time. It was just from a timing standpoint, time to sell those assets. And we sold those probably 2 or 3 years ago.
Got it. What are your thoughts about office? Everyone's got their own opinion as to, how this pandemic is going to affect office and this behavioral habits of employers and employees, wanting to be in an office environment. What are your thoughts on that? And are there concerns for any of the office products that you own?
Yeah, I guess the way I would answer that question is I'm not looking to buy any office properties. Okay. And I can tell you that it's probably a situation where market to market, the large employers are the large economic engines or drivers in a lot of markets. So you're probably going to have varying opinions on this. So that has a lot to do with it. But I can tell you from my experience so far is, at least over the last couple of years, I would not be out looking to buy any office properties, even if it looks like you can get those at an extreme discount. Let's say compared to, replacement cost, for example. I wouldn't do that. And secondly, with the office properties we have now, I can tell you, with the office properties we have, they're older. So they're built in the late 80s and early 90s. So they're not, anything that has any new technology or new or newer environmental or anything like that involved with them. And it's interesting because we'll go from being full for a few months to like having a see-through office building for another few months. and kind of a see-through office building the next year. And that's just kind of the cycle that I've seen, and it's the unpredictability of that, and the unpredictability of how well some of these businesses are going to do, just leads me to really look for something different. And I can tell you, again, just my opinion, of course, if I wouldn't have business interests in these offices I'm speaking of now, I would probably look at selling those.
Got it. No, that makes sense. And as far as multifamily is concerned, have you, really specific to the Heartland region where you spend most of your time investing, or I guess all of your time investing, have you seen any type of adjustments in pricing here since, I guess you could say, back to April when the pandemic started?
Yeah, I would say now when you're talking about pricing, are you talking in terms of rent levels or sales price levels?
How about both? Let's actually, I was going to say sales price levels, but in fact, I think that it's relevant to speak to both of those, both rents and sales price.
Yeah, I can tell you it's kind of weird. So if you and I were sitting in a room and full of folks and somebody said, hey, how did 2020 go for you? Okay. There probably wouldn't be anybody in the room that would be surprised if I said it was absolutely terrible. Rents were down, demand was down for multifamily communities, of course, not only because of COVID, but a lot of other things going on at the same time. But oddly enough, interestingly enough, 2020 was a really good year here, at least in our market here in the Heartland anyway. I can tell you rents on our communities, we were able to increase our rents, not on all of our communities, because we purposely on some of them kind of took the position of, okay, let's wait and see what happens here. Mm-hmm. Okay, let's wait and see what happens with COVID and how it's all going to shake out. But I can tell you in the third into fourth quarter of last year, when we got a pretty good sense that we weren't going to be affected nearly as bad as what we may have thought earlier in the year, we were raising rents a little bit under 10% across the board on most of our communities and not getting any pushback whatsoever. Okay. So rent levels, we were able to increase those, not as much as probably what we had budgeted and projected early in 2020, of course, but, a little bit less than 10% under the circumstances. Very, very happy with that. And then when you jump to sales prices, the demand for multifamily from investors wanting to own them, in especially towards the last half of 2020, was much, much higher than what I anticipated it would be. And so, and this, Kevin, as an owner of mobile home parks, the amount of calls and activity you get from folks looking to place capital, real estate brokers, those kinds of things, those are pretty consistent. Mm-hmm. Well, I can tell you the last half of 2020, I would be getting at least one or two calls a week on one of our communities from somebody having an interest to buy, in buying them. and to kind of quantify it for you and for your folks in terms of thinking, well, what are you talking about up here? Or what are you talking about? A typical garden style apartment property that, let's just say, is a B class kind of property, towards the end of 2019 into 2021, pre-pandemic, was probably trading for about $40,000 to $45,000 a door. Okay. I can tell you, once we got towards the end of 2020, it was now getting pretty close to around $48,000 to $51,000 a door for the same kind, same vintage multifamily property. So steady demand and some steady increases in values. Again, kind of surprisingly, because beginning of the year, you'd think, oh, God, what's going to happen? But we were fortunate where we got some pretty good rent raises towards the end of the year, and also fortunate in terms of the demand for the properties that we've got here as well from investors.
Yeah, no, that's good to hear. I appreciate that. As far as, your types of acquisitions that you're seeking, is it always existing product, or have you also done some multifamily developments?
I'm a paint myself in a corner guy, Kevin. And what I mean by that is I have stuck to, I'm going to give you a long answer to your question. I've stuck to existing properties, preferably anywhere from 10 to 30 years of age, in average to above average locations that realistically look as if there can be some things we can do once we take over, from an increase in rents and maybe some expense reduction and gaining some value out of that. And our target hold on most properties years or longer. And here's why I've not gone into the development business. And there's going to be, you may tell me I'm crazy. I would rather purchase apartment communities in this, in the $50,000 a unit range, than and feel really, really good. At that price level, with new construction in the $150,000 to $200,000 a unit level, and hoping it's all going to work out. Service obligations, right? But also to provide myself and other investors a good return. And when I've sat down and done the numbers, at least here, the numbers just scare me in terms of a good multifamily property. So I've gone through the exercise many times, calculator more times than you could probably count. I just can't get it to work to where I'm comfortable. So my default is, the typical garden style units that are 10 to 30 years old in good locations.
Most of these shows I do, and I think most podcasts I listen to, everyone always talks about the best deals, right? The ones that made the most money, had the highest returns, had the least amount of challenges. So I always like to take the opposite approach, be the contrarian here, and let's talk about the worst deal, because you've been in this business now for 30 plus years, and it's inevitable that not every deal goes as planned. There's many that have had more hair than others, and many others that have just not gone the way that you anticipated, from the get-go. Although everything looks great on the pro forma, you're excited about it. I feel like there's always skeletons, sometimes more than others. There's always a skeleton or two in the closet on any property that you're acquiring that's used. It is what it is. You don't know what you don't know until you get in and start operating the property, even if you're buying from a completely 100% honest seller, right? And so with that being said, I'd love to get your feedback or perspective on whatever you deemed to be the most challenging deal that you've ever come across, that you personally have done as a principal over your 30 plus years in the business. And it could be one where you lost money, maybe had a bad partnership, all the above, just whatever you classify as the worst deal. What is it and what happened?
But before I tell you the story about one of those, I want to tell you, and I want to compliment you on how refreshing it is to talk to someone that is ready, willing, and able to talk about the mistakes that have been made, and I'll just say it, the shit that comes up that you don't expect. Mm-hmm. because there's a lot of folks out there that never talk about that stuff, right? A lot of folks want to talk about everything that always worked great, but you never really hear them talk about the things that have not worked out that well. And if you've been doing this long enough, you will definitely have some projects that just don't work out. So I just want to compliment you on bringing this up, because not a lot of people do, and I think it's important. So yeah, I can tell you about, and your listeners are going to appreciate this, because I'm going to probably hit some hot buttons that a lot of them are going to be familiar with. So property available in that's been recently renovated. It's a 60-unit apartment community consisting of 10 side-by-side 6-unit buildings. Okay. Properties just recently renovated, so new floor coverings, new appliances in a lot of units. Not a total gut every unit, but at least cosmetically, the place looks great. Interior, outside, and inside. And so I hear that this property is coming on the market. So I contact the owner and have a conversation with him about selling it to us. A partner and I go and look at the property, and we discover that everything is great about it, except it's in a location that's not that great. So what I mean by that is properties across the street have cars that are up on blocks. There's some retail stores down the street with broken windows and for rent signs, and you can tell no one's occupied those for a long time. There's a hotel down the street with a big for sale sign on it. But hey, we're really smart guys, and the property's in really good shape. And in addition to that, because we're so good at negotiating, Kevin, we negotiated the seller to carry back the entire down payment. So we're in this property at about $22,000 a door, newly refurbished most of the units, with no money out of pocket. How can we go wrong with this, right?
Yeah, it doesn't seem like it gets any better than that, right? But I know where this is going, I think.
Yeah. Yeah. Because we're really smart, we're smart guys.
The deals where you think you can never lose are the ones that you lose the biggest on. It's at least my personal
that
experience.
Is so very true. So within the first year of owning it, we had this is when I really discovered there's a huge difference between being fully occupied and having your rents fully collected. Big difference. And so we went through 3 property managers in a year. You throw in some missing money and who knows where it went in there in that equation, along with one of the tenants walks in on a lady he was evidently living with in one of the buildings and finds her with another guy, with another man, leaves, decides to pour some gasoline in a bottle, light the bottle on fire, throw it through the window into the apartment.
Oh, wow.
So that building burns to the ground. Thank goodness nobody was hurt. Later on that year, in the wintertime, another one of our buildings, heat's not on for some reason. Pipe bursts, of course, in the top unit. Water cascades down the entire building. That's a complete loss. And we haven't even owned it a year yet. Into the collection issues I was telling you, and the management, in the management company carousel that we were going through. So now we own it about a year. And we're looking to find some insurance coverage. Well, do you think the insurance company, Kevin, that we had our insurance with is interested in renewing their policy with us at this time?
Heck no.
No. As a matter of fact, because of the well over 7 figures in losses within less than a year's period of time, we couldn't find anybody. So we did ultimately finally find one carrier. And there's really the most risky insurance carrier in the world is a company by the name of Lloyd's of London.
Mm-hmm.
And when you get insurance from Lloyd's of London, it's not cheap. The insurance premium was so high, Kevin, we had to finance the insurance premium. That's how high it was. And so after a little bit over a year of this, do you think that we're thinking we made a really good decision in buying this property? Of course not. And so rather than if we did anything smart, or if I did anything smart on this, it's finally come to the conclusion that we need to cut our losses. So we cut our losses. We ended up selling it a few months later. We sold it at a loss, and it was one of the happiest days of my life, selling that property. That is a story that I actually don't mind telling. Because again, like I said before, there's a lot of folks that'll talk about all of the things that they do right and all of the big wins, but the big mistakes that people will make, the properties that don't work out, if you do this long enough, you're going to have them. And as long as you take things away from those experiences, it makes you a hell of a lot better owner, investor, and manager moving forward. So if there's anything I'm thankful for about that experience, is kind of getting back to what we originally talked about, knowing what I know now. Now I know what to avoid, what not to get into, and that puts millions of dollars in my pocket.
Yeah, no, I love that. It sounds like it's the classic case of not trusting your gut, because it sounds like you had an inkling that, although this property had been rehabbed and looked phenomenal, it just wasn't in the best part of town. And I've got the saying that you can change the tenant base of a really rough property, but you can't change a really rough market, right? I mean, you can remodel the property, make it great, but if it's in a really rough market, the only thing you're ever going to be able to attract is a less than desirable tenant base. And so you can change the market, or you can change the property, but you can't change the market that it's in. And so you can't change that part of town. And it sounds like that was a big part of the problem there. Would you agree with that?
Yeah, I'm glad. I wish you would have told me that. Where in the hell were you? I'll tell you just a really quick follow-up story to that to hit your point. So, excuse me, I'm at the resident manager, and I'm talking to the resident manager there about something. And as I'm talking to him, he gets a call on his cell phone from a prospective tenant that's trying to find her way to the apartment to view a unit, and she's lost. She's having trouble finding the place. So he goes outside of the building where the office was at. I go with him, and he's, picture this, he's standing in the yard on his cell phone, basically guiding her to the property. Okay. So after a couple of minutes of him on the phone, and I'm standing out there with him, she pulls up to the curb. She sits there for about 10 seconds in her car. She steps on the gas, peels off, never heard from her again.
That's not a good sign. Yep, not a good sign.
No, I wasn't laughing then.
Yeah, that would definitely make you think twice. But it sounds like it was too late at that point in time, right?
Oh yeah.
Yeah, you're knees deep. Well, what advice would you, knowing what you know now, what advice, outside of this particular one deal, but what advice would you give someone that's looking to get started in the multifamily space, or just maybe commercial real estate investment space? You can kind of take it from whatever angle you'd like.
So the first thing to know is there's not going to be any such thing as a perfect property. Okay, so no matter what, and to your point, you kind of mentioned this earlier, there's never going to be anything perfect, and even the most perfect property you think you're looking at buying or investing in, you'll find a surprise, at least a few surprises here or there that are going to come up, and this may even be during due diligence. Okay, so you want to know going in that there's no such thing as a perfect property. However, you also want to have a certain set of criteria that, the criteria doesn't necessarily need to be etched in stone, and you can't waver from that at all. But on the other hand, you just can't waver from it too much just to get a deal done. So I think a problem that some folks can run into is, this is especially after, I went and I spent all this time on due diligence. I spent all this money on the due diligence. I went out there, I toured the property. I put all this work, all this time, all this energy in this property. And then at the end of the day, you find out, it might not be as good as I thought, nor meet the criteria that I really want. But, I put so much work into this, I'm just going to close and I'm just going to make it all work, or hope it all works. That's a mistake.
Yeah.
That's a mistake. And I would say it's tempting to do that. It's easy to do that. But you don't want to. So you take my little story, my example is, we spent a lot of time on that property. I find out it's not really in the location that it really should be in, but geez, Kevin, we put so much time into this, so much work. My partners, they want to get their money into a property. They don't want to wait around anymore. Let's just pull the trigger and let's just get this done. And that's not the approach you want to take. You're better off keeping your chips off the table, and finding the property again, knowing there's no such thing as a perfect property. Okay. Finding a property that's going to be as close to that criteria as possible versus kind of throwing caution into the wind and jumping into something just for the sake of getting a deal done, getting started, getting investors' money or your money in a deal. I mean, that's all good, but months down the road, you're going to say to yourself, what the hell am I doing? Well, why did I do this? Should have waited. That's really the wrong time to have that, to realize that.
Sure.
So kind of coming full circle, stick to your criteria, be a little bit flexible. No, you're not going to find the perfect property, but don't get a deal done just for the sake of getting a deal done.
Yeah, no, that's great advice. I mean, there's been deals. I mean, there surely have been deals that I would say probably earlier in my career, I might have thrown caution into the wind, and they could have still turned out just fine, but maybe a little bit more stress and headaches than what was necessary. And then there's other deals, probably more recently over the last 5 to 7 years where, we've had some pretty significant, after kind of learning that, throwing caution in the wind typically does not work in your favor in the long run. And over the last 5 to 7 years where we've had fairly significant pursuit costs tied up, not just time, but, third-party reports and due diligence expenses, and where we walked away from deals. I mean, I think probably the biggest one for me that we've walked away with, and as far as lost the pursuit cost, was right near $100,000, which is a lot. It's a lot of money. It's a lot of money to know that I am not getting that back. It's not coming back, and I wish we could have figured out earlier. But it was one of those things where it was a very short time frame, and we had to order everything all at once, and it was a very rushed situation. So it was inevitable that we just wrapped up a lot of pursuit costs very quickly, and there was no turning back once we kind of pulled the trigger and move forward with them. And then we had to either say yay or nay, and we opted out of the deal and ultimately left a lot of money on the table. So, but in my opinion, Darin, I mean, there's always another deal. I mean, there's always another opportunity around the corner, and I think that patience really is a virtue, and just be patient. Know that there's another opportunity. One of the things I'm seeing nowadays is that it's a little bit of a deja vu to the I guess the the vibes that investors were putting off back in 05 and 06, as far as, I will pay anything because if I don't buy it today, the prices, I'm going to get priced out of, this house. I'm going to get priced out of this apartment community. I'm going to get priced out of this mobile home park, whatever it is. and they're paying, numbers that I have a hard time sometimes making sense of. Even a few deals that we've sold over the past year, I've had a very difficult time making sense of what the end buyer was purchasing that from us at. And but I feel like part of that is, hey, the market's hot, inventory is at an all-time low. If I don't buy today, there's never going to be another deal coming my way. So I might as well buy and just, take a little bit thinner margins. So I don't know if you're seeing the same thing, but that's kind of my general consensus of what I'm gathering from what I've seen over the last 2 years.
I think that what you just said is spot on. And there's a lot of really, really good, there's a lot of really good wisdom in what you just said, because it is the way the market is now. And, especially with technology allows marketing properties now to such a wider audience and a more qualified audience so much easier. And now you're dealing with an audience that, kind of gets back to criteria, but there's a lot of investors whose criteria is fine in their minds, even when the numbers aren't working out that well, because of some of the reasons that you just mentioned. And so, as a result, it drives prices up. And I got a mentor of mine. He didn't really coin this term in relationship to real estate. He did it in relationship to buying businesses. And his term, which is really good, is there's always going to be another bus coming. So, and the tough part for guys like you and I and those folks listening to the podcast, we're entrepreneurial anyway, right? So, it's kind of in our DNA to get deals done and to be very optimistic about our abilities, about what we can do, how we can do it, time frame, budgets. We're really, really optimistic about all that because our DNA is kind of geared to that. So it's hard. It's hard. But, the amount of money and time, because time's a big deal too, that you will end up saving and thanking yourself that you saved as a result of avoiding those projects, apartment communities, mobile home parks, medical office build, whatever it is, that the numbers are just like, what the hell? I don't get that. I don't get how anybody can make this work. Well, maybe I'll just give it, you want to definitely avoid that, even though it's so damn tempting to jump in and be real confident in your abilities to do in order to make the project work. You were definitely in a market where your thought should be another bus coming.
I love that. Darin, where's the best place for our listeners to find out about you and to make contact with you?
It's pretty easy. So my website's probably the best place to go, and pretty easy. It's my name. So it's www.daringarman.com, and I'll spell that. It's DARINGARMAN.com. So DarinGarman.com is where you want to go to get any kind of information, or you want to be hooked up with what I've got going online. That would be definitely the place to go.
All righty. Good deal. Well, Darin, thank you for joining us here today. It's always a pleasure having you, my friend.
Hey, buddy. I appreciate the opportunity. You have a great day, bud.
All righty, guys. That's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. We'll see you next Monday morning.